Welcome to The Explainer. You know, a lot of people think being a landlord is the end game. Well, today, we're going to move way beyond that simple mindset. We're going to unlock the financial thinking of a real pro investor and see how they look at properties in a completely different way to, really max out their returns.
All right, so let's just jump right into this because I know what you're thinking. More cash from more expenses? That sounds totally backwards, right? But stick with me because this one kind of counterintuitive idea, it's the absolute key. This is how the savviest investors legally and very effectively boost the actual real cash that lands in their bank accounts.
So the first myth we've got to bust is this idea that profit is everything. You know, that number at the bottom of your P&L statement? Most people think that's the holy grail, the end-all be-all. But for a professional investor, nah. That's just the beginning of the conversation. And to really get why, we need to draw a sharp line between two very different things. First, you've got your profit and loss statement, your P&L. That's what you report for taxes. But then you've got your cash flow, your CF, and that's the cold, hard cash that actually shows up in your bank account. And let me tell you, they are almost never the same thing.
Okay, so here's the real kicker. Your P&L, it works on something called an accrual basis. All that means is it records a sale the second it's agreed upon. It's basically a promise of money. Think about it, like Mr. A saying, "Yep, I'll buy it, but I'll pay you later." Your P&L shows a profit right then and there, even while your bank account is sitting at zero. See the problem?
All right. So if we can't fully trust the P&L profit, what about that big flashy number you always see on property listings? Let's talk about gross yield and why, if you rely on it, you could be making a very, very expensive mistake.
The reason gross yield is everywhere is because, honestly, it's super simple. You just take the annual rent, divide it by the purchase price, and boom, you have a nice-looking number. But it's a fantasy. It's a calculation that lives in a perfect little world where nobody ever moves out, nothing ever breaks, and you don't have to pay a manager. It completely ignores all the real-world costs.
And this chart is the perfect reality check. Look at that. The gross yield they advertise is a juicy 12.5%. Looks great, right? But once you start subtracting all the real-life costs, the management fees, the repairs, the taxes, the fact that a room might be empty for a month, you get the actual yield. That's your net operating income yield, or NOI yield. And what happens? It gets sliced in half, down to 6.25%. That is the number a professional investor lives and dies by.
Okay, so the big takeaway so far is we have to account for real costs. But now we get to a really interesting one. There's a special kind of expense that, well, it isn't a real expense at all. No cash ever leaves your pocket, and yet it works like a magic wand for saving on taxes. We're talking about depreciation.
So, depreciation is purely an accounting thing. It lets you take the value of the building, and this is important, just the building, not the land, and write it off as an expense over time. Now, check out this example. With an older wooden apartment like this one, you can write off that entire 18 million yen building value in just 4 years. That creates a huge 4.5 million yen paper expense on your books every single year.
And here's where the magic seems to happen. If you're an investor in, say, a 40% tax bracket, that 4.5 million yen paper expense slashes your taxable income. The result? You save 1.8 million yen in actual taxes. That's not paper money. That's real, spendable cash that stays right there in your pocket.
But wait, it gets even better. You do that for 4 years, and those savings add up. We're talking about an extra 7.2 million yen in your bank account. Think about that. Your rent didn't go up, nothing really changed, but you have all this extra cash. It totally feels like you found a cheat code for the game of real estate. But, and this is a huge but, here comes the catch. This is probably the single biggest thing that separates the amateurs from the pros. That free money, it was never free. It's a tax deferral. It's basically a loan from the tax man.
And here's exactly how you pay it back. When you go to sell that property, the tax office comes knocking. They say, "Hey, remember that 18 million yen in depreciation you claimed as an expense? Well, we're now subtracting that from what you originally paid for the building. What that does is it artificially crushes your purchase cost, which in turn creates a much, much bigger taxable gain on paper.
So just look at how this all shakes out. You got that plus $7.2 million in tax savings while you owned it. Awesome. But then you sell, and bam, you own extra $7.2 million in taxes. The net result? A big fat zero. The government giveth, and the government taketh away. The magic bullet? Well, it was just a puff of smoke. An illusion.
So, was that all just a big waste of time? Is depreciation useless? No, absolutely not. It just means the real magic isn't in the disappearing tax bill itself. Now we get to the pro-level strategy. How you take this tax loan and actually turn it into real, keep-it-forever profit.
See, a pro knows that depreciation isn't about erasing tax. It's a tool for planning, and there are a few really smart ways to use it. First, there's the time value of money. Getting that cash today is way better than getting it years from now. You can also use those paper losses to cancel out real profits from other investments. But the most powerful, the most elegant strategy of them all, the one we're going to dig into, is called tax rate arbitrage.
This is just beautiful. It all comes down to timing. The tax rate you pay when you sell a property changes a lot, depending on how long you've owned it. If you sell in under 5 years, you're looking at a short-term capital gains tax of around 40%. But if you just wait and hold it for over 5 years, that rate gets cut in half, down to about 20%.
Here it is. This is the punchline. Remember, you saved that $7.2 million tax deferral at your high 40% income tax rate. By just holding the property for a little longer, more than 5 years, you pay it back at the much lower 20% capital gains rate. What does that mean? You only pay back half of what you borrowed from the taxman. The other half, that $3.6 million, just became permanent, real take-it-to-the-bank profit. Now that is the pro move.
Okay, so this brings us to the final and, honestly, the most important point of all. There's no such thing as a single best strategy in real estate. It just doesn't exist. The right strategy, the right move, depends completely on your own personal endgame.
Think about it like this. That old wooden building with its fast depreciation, that's an amazing tool if your main goal is to generate cash flow and get tax savings right now. But a shiny new concrete building, it has way less depreciation, but banks love its collateral value. So it's a much better tool if your goal is to get financing to buy more properties. Neither one is better. They're just different tools for completely different jobs.
So at the end of the day, the most important thing you can do is define your own goal first, before you even start looking at listings. What are you trying to do? Do you need cash flow today? Are you playing the long game for appreciation? Are you trying to build a big portfolio that you can borrow against? Or maybe you're just planning for your family's future. Once you know your why, then you can choose the right property and use these tools to win. You have the tools now. So the only question left is, what kind of investor will you